Welcome, everybody. As always, I'm excited to be here and hope that you are as well. It's Friday. That means that we have a lot to talk about in the market. Uh, there are options that are expiring today, and so a lot of trades to review. Before we dive into that, one item of business, really quickly, in the chat area, I've posted a poll about next week. It's going to be Black Friday, day after Thanksgiving. One of the advantages of being here live is that you get to decide what we're going to do with next Friday. If you want to hold this live stream, as usual, the market is going to be open for the record. It is going to be a shortened trading day. The trading hours will end at 1 p.m. Eastern time, but the market is going to be open. And so, if you would like to hold this live stream, that's fine with me. If you would like to take the day off so that you can enjoy the Black Friday activities, whatever they may be, then that's okay too. So if you could respond to that poll and let me know, majority wins. Very simple. So we'll see how that lands. All right, Barry's fine either way. Going to go with the consensus if you're up. Okay. And that's the question, right? If we're up, that's part of the question. Would you prefer to maybe sleep in, being that it is Black Friday? So, all right. Well, thank you. Again, I'm just going to go with whatever the consensus may be on this one. So if you have a preference, please do go ahead and vote in that poll. Go ahead and dive straight in. Hopefully, we'll get a few more people coming in as we get things rolling. I'm going to leave the poll up and see where we land by the end of the session. Just really quickly for those of you who may be watching this for the first time, live or otherwise, the purpose for this live stream is to look at the market under current market conditions and apply the Rebel income investing method, the lens of that method against what's going on in the market. So we're going to review some of the trades that I've highlighted in my trading alerts and that I am following, that I've placed. Going to talk about those in real time while the market is open, and talk about how current market conditions might impact what is happening with those stocks, and review some of the choices that are available for those stocks, whether that means making some adjustments, keeping things staying the course, keeping things steady, or doing something completely different. The idea here is to try to talk about the application of income generation in the most practical terms possible. When I talk about income generation using the stock market, I'm talking about two primary components. One of those is that I put a big focus on dividend paying stocks. You can see on my chart here, I've got Kroger Company up. This is a really good example of a company that I've followed for some time and that pays a regular, consistent dividend. Stocks that don't pay dividends, it's not that there aren't some really great companies out there that don't pay dividends, but they don't qualify for consideration in the Rebel income system because the dividend component of these stocks that have a dividend payout is part of the income generation strategy that we're going for. The primary focus, however, is on using the options market against these stocks to generate income. That's using trades involving put selling or possibly even covered calls in the case where we end up being assigned a stock. That also means that the selection process for the stocks that we use for our trades has to be very deliberate. When you're using the options market, you have to understand the different dynamics that come to play and the obligations that are created when you sell an option. Most option traders are buyers exclusively, and that means that the only part of the transaction that that they're accustomed to thinking about is the buying side of the transaction. Well, buyers have choices. If I buy a call, I have the choice to I have the choice of buying the call at excuse me. I have a choice of buying the call, buying the stock. Excuse me. The choice of buying the stock at the strike price uh, that is specified by the call, and then selling it at whatever the current market price is. That's assuming the stock has risen above that strike price. The put sale, it's the opposite. Well, for sellers, rather than choices, sellers have obligations that have to be considered. And so we take the sell side of the transaction. So we have to think about what those potential obligations are and how those relate and are impacted by what is going on in the market right now. So we're going to be looking at some of those recent trades and currently open positions through that lens. Hopefully, we'll have some time as well to go over some of the stocks that you may be following, and so we'll see where we go. But let's go ahead and dive straight in. All right. There are a number of positions that are on deck for this week, meaning that their expiration day is today. That means that I'm either going to be looking at if it's a put sale, I need to consider whether or not I'm going to be assigned. When you sell a put option, you're giving the buyer the right to buy the stock at the current market price and force you to buy it from them. They're going to sell it to you at the strike price that you sold. Why would they do that? Well, let's use EMN here, which is the first stock on my track record as an example. I sold the $55 strike price on this one. This was about a month ago when I placed this trade. Now, I generated about 2% return on this, which was a nice return for that trade. But all of that is kind of secondary to what I need to think about right now, which is that $55 strike price. That is the obligation that I have to think about. If the stock has dropped below 55, and it could be anywhere between, uh, thank you, Barry. Thank you, Jay. Good morning. Welcome. All right. As mentioned, we're going to go with the majority on the poll. So far, it looks like we're going to have it, which is awesome. That's fine. Selling the $55 strike price means that if the stock is down at 50 or 45 or 40, whatever it may be right now, the put buyer can buy the stock at that price, at the current market price, and then sell it back to me at 55. Why would I do that? Why would I sell that option and create that obligation? Now, Jay and Barry, who are the ones that are here live right now, you guys know what the answer is, but I'm going to go ahead and throw it out to you and let you answer that question. Why are we selling a put option on a stock when we're opening ourselves up to that potential obligation? What is the rationale? Jay, we make money either way on the sell. We hope so, right? Now there is the potential of being forced to buy a stock as it's dropping and as it continues to drop. So we have to think about that. And thank you, Barry. Get paid to buy a good company, and that's really what that. Thank you. You're both correct. But I want to start with Barry's point, which is getting paid to buy a good company. Spend a lot of time trying to focus on the fundamental strength of each individual company that I use for a put sell, and I try to make sure that there are some minimum criteria that are being met. Um, so I'm looking for a good company, exactly the way that Barry outlined. Um, that also means that for me, the selling price, that strike price that is associated with the put contract, is I take that as my buying price. So the question becomes, if I'm selling the $55 strike price for EMN, then is this price, I'm just going to go ahead and, here it is right there, 55. If I'm going to sell the $55 strike, does that strike price represent what I think is a good price for the stock? The other element of the Rebel income system is that I call it a value-driven system or contrarian system, because we're looking for stocks that are trading at relatively attractive discounts. That means that I'm looking for long-term upside in these stocks that should be well above the strike price that I'm selling. So if I'm going to sell EMN for 55, if I'm going to potentially have to buy the stock at this price by selling that put option, then I need to be confident that there's upside well above 55. And so I'm in effect trying to set the price that I'm willing to pay. Now, that is not necessarily totally uh, uh, that is not a decision that I make without considering what the current momentum of the stock is, but that is primarily driven by my fundamental analysis and what I believe the quote unquote intrinsic value of the company is. Okay, so in this case for EMN, I'm saying that 55 is a really nice price, and for that, this is the income part of this. For selling that potential obligation, I was able to bring in $1.05 per share. Now I sold one contract here. One contract controls 100 shares. So that's $105. But when you sell a put option, in order to cover that obligation, you need to have cash or margin reserve available that is sufficient to cover that potential purchase. So since I sold one contract with a $55 strike price, I need to cover 100 shares purchased at $55. In simple terms, then, I have an obligation to cover 55, and I apologize for the bad handwriting here, $5,500. And I need that either in cash or margin or a combination of both. I prefer to work on a cash secured basis, which means that I don't want to dip into margin at all. But that means this is the capital reserve obligation that I need to keep in the account throughout. That's a requirement that every broker is going to enforce. Okay, so let's check in with EMN and see where we're at. Now, this stock chart looks really scary because the stock has been in a very long-term downtrend. The thing is, that downward trend is exactly what has created the discount. This is the contrarian part of what we're doing with Rebel Income, because most people are looking for stocks that are going up. The expectation is that a rising tide lifts all ships. And so if you're working with a stock that is already going up, you've got momentum working for it. Well, the contrarian view, which is what I subscribe to, which is the longer that an upward trend lasts, or a downward trend for that matter, the longer a trend lasts, the more likely it becomes at some point to reverse. And so what we're trying to do is we're looking for these deep discounts. That means looking and paying attention to stocks in these downward trends and recognizing that the length of that downward trend could be creating not only a good discount, but also a technical opportunity to possibly buy the stock at an early point. Yeah, Barry, thank you. What goes down usually goes up eventually, especially if it's a good company. This is where that value proposition, that discount, comes to play, and where the fundamentals of the company become really important. Because if those things are in place, it doesn't mean that the stock won't continue to go down. What it does mean is that at some point, the market is going to recognize those fundamental strengths. And it's going to recognize how deeply discounted the stock is. And that's when you start to see the turn back up. In the meantime, what we're taking advantage of is the opportunity to generate this attractive income using put selling, and by setting the price that I'm willing to pay. Now, the stock is at 57.28 right now. That's above 55, so I'm actually in a pretty good spot. And that's one of the things that's ironic about this chart, is because no matter, despite the fact that it looks pretty scary, we've got pretty good support going on here around $57, and my strike price is actually at 55. Sometimes this is one of the great things about that I really like about put selling, is that it sometimes the stock's price volatility impacts the implied volatility of the options in such a way that you can set up a really conservative overall position. Now, with EMN, part of the logistics of that trade are set by the fact that this is a stock that only offers monthly options. A lot of stocks out there will offer options that expire every week. Eastman does not. They offer standard monthly expirations. So these options expire the third week of every month, and they only sell $5 strike price increments. You see 55, 60, 65, etc. here. So there was not an opportunity to go at 57 or something like that, but the implied volatility is high enough that these are still pretty attractive. There's the bid and ask at 60. 55 here is still the first out of the money strike price. So that's pretty interesting. Now, here is the contract that I'm looking at right now. This is mine. This is the contract that expires today. Remember, I brought in $1.05 when I sold this put option. The stock pushing above 57, that means that there's a very high chance that this option is going to expire worthless, which for a lot of people is kind of an ideal result. That's a good result for me. I like it when that happens. But again, I also don't avoid put assignments from these put sales, because these are prices where I would like to where I would like to own the stock. But with that in mind, let's take a look at the bid and ask price here. The asking price is 10 cents. This is another thing that we have to get used to doing when we're taking the sell side of these transactions, is the transaction itself, the logistics are different. Instead of buying to open, we're selling to open. That also means that if you want to close the trade before expiration, you have to buy to close. Anytime you buy, you're always buying at the ask price. That's no matter whether that's a buy to open or a buy to close. So you always buy at the ask. That means that if I wanted to close this trade before it expires today, and it expires at the close of business, the option is still live. It's still active right now, but it will expire and simply vaporize, simply just disappear as soon as the market closes. Now, if it does that, then that means that I hang on to the entire $1.05 that I brought in. Why does the current asking price and the stock's position relative to my strike price matter right now, beyond the fact that it looks like my option could expire worthless? Well, the opportunity could be to buy it back before the market closes. I'd have to pay 10 cents for that, which means 10 cents, which means I'd be able to hang on to a net 95 cents in the trade. Now, that's still a really attractive overall yield. Let's see, I need to get my calculator, just a second. Here we go. 95 divided by 55 means I would still be bringing in about 1.72% for a 30-day trade, which is attractive. I'm generally trying to get about 1.5% per month on average. So this is above that level. But why not just simply let this expire worthless? What is the advantage? Well, first of all, as a lot of the people that are here live already know, the first advantage is that closes the obligation immediately. And the reason the reason might sound like I'm splitting hairs, but there's actually a very real difference between just letting the option expire or trying to buy it back before the market closes. When you buy it back before the market closes, that $5,500 that I referred to earlier, sorry, this is what I wanted. That $5,500 reserve, if I buy the option back, I do a buy to close order. This comes back immediately and is immediately available to redeploy in the market. And that's awesome if I have an idea of what it is that I want to do next with the money. If I don't, maybe I'm just better off waiting. If I let it expire, that's also okay. I would hang on to all of the premium as opposed to having to giving some of it back. So hanging on to all of the premium, that's a nice result too. But trade settlement in that case is different. Normal trade settlement when you let an option expire is usually 1 to 2 business days. That means that the earliest that my capital would be available for use in the next trade would be Monday or Tuesday of next week. Now, I'm okay with that. That doesn't bother me. That's what I'm used to working with. And my system is structured for my own purposes to operate within exactly those bounds. But here's the advantage of buying it back early. If I buy it back early, that $5,500 is available to redeploy right away. If I still like EMN, this is another 28 days, another month out. But here's the $55 strike, same strike price. And the stock is looking like it's got some pretty good stability around 57 right now. I could sell this for $1.60. So here's the $1.05 that I brought in initially. This was a positive. And if I sell it or buy it back, buy it back to close, my net credit is 95 cents. Then if I sell again and I just simply try to get this same bid price right now, and I add $1.60, and I apologize for the bad handwriting here. Now we're looking at, positive $2.55. $2.55 of income generated in a 2-month period. All right. Now remember, my original put selling trade gave me about 1.91% total premium. If I let that expire worthless, that's going to be all I get out of that. By buying it back, I'd have to give back some of that, but I'd still make about 1.72%. But then I'd have the opportunity to sell this $1.60 contract almost immediately. And so the $2.55 in total premiums generated, divided by that same $55 strike, now my total yield for 2 months goes to 4.63%. Okay, that's actually really, really attractive. You can annualize that if you want to simplify things. These are practical numbers, by the way. These are real. This is what's available right now. This is why I call put selling, the picking the low-hanging fruit of the market. This is available right now. These are not made up numbers. This is real. What I'm about to show you, this is simplified. If I want to try to annualize this, let's think about 2 months. How many trades am I going to be able to place if I'm doing this on a monthly, if I'm doing the same thing every 2 months, right? It's the 4.63%, which is what I'm talking about. It means I'm going to place about 6 trades. If I can reprocess that same thing, which is really placing a trade every month, so 12 trades, but the net overall result here is almost 28%. If I simply do the 1.91% that I'm bringing in now, and I repeat that 12 times, and I'm only getting about 23%. So there's almost a 5% difference between these two methods just by buying back on the day of expiration. It may not sound like a lot, but if you can do that over and over and over again on every trade that you're making, or as often as the market is allowing you to, then that starts to add up. And that becomes a very, very real difference. And it becomes a very real advantage that a lot of people who manage their put selling trades more actively than I do give themselves. So why am I not doing this? This is one of the things that's kind of fun that a lot of the people in the group have asked me many, many times, almost yelling, why aren't I placing these trades? Why am I not doing exactly what I've outlined? My method is to let the result be the result. And by that, I mean, if I'm selling a put option that expires today, I'm going to let that play through to expiration. If I get assigned, I get assigned. If I don't, I don't. I wait the next couple of days for the trade to settle, and then I go and then I move on. I'm okay with the fact that I'm not placing as many trades. I'm therefore not generating the same return numbers as somebody who's managing their trades more actively. This isn't about right or wrong, except what is right or wrong for each individual. What we have to think about is what makes the most sense for your system. What helps you achieve your goals in the most sensible manner, and what makes the most sense to you. Okay, well, we spent a lot of time talking about EMN. If any of you have a comparable number you want to throw out, then please do go ahead. And so far, it looks like we have a split result on the poll. So Barry, I may need you to go ahead and break the tie if nobody else does before the end of the session. All right. So the next put sale that we have, let's see. Well, every other trade. No, we do have, every other trade that we have that is up for expiry today is a covered call. So these are all stocks that I took assignments from put selling trades, and that I have been holding. This activates the second leg of the income generation system that I like to use with Rebel Income, and that is the fact that since I own the call, or own the stock, excuse me, I have an opportunity to sell calls against it. That's especially attractive if the stock is at or above the strike price that I was assigned the stock. So let's start with the first one, and that's Coterra Energy. This is a stock that I was assigned in October. Middle of the month at $24. Barry, I would say yes, but I cannot guarantee be up and moving at that time. It's been a rough couple of months. You know what, Barry? Then then I'm going to count it 2 for no and 1 for yes. It sounds like you could use a break, and that's okay. So for now, Yeah, I'm going to count you as a no. Call that an executive decision if you want. All right, let's take a look at CTRA. So as I mentioned, I own the stock, was assigned shares at $24. The stock has been pretty volatile so far this month. Really sharp upward move to begin the month after its earnings report, and it's been dropping back pretty sharply since then. And this covered call trade was set up shortly after the assignment. So while the stock was in the middle of this initial really impressive rally, the thing is, my 24.50 call is back here in this range. So there's still a little over $1 of distance between where the stock is now and the covered call strike price. So it does look like I'm going to get called out of this trade. That creates a really nice result where I'm going to looks like I'm going to be called out of the stock. Now, it is interesting that the stock is not quite a full dollar above the strike price that I sold on this covered call. So that does mean that assuming the stock finishes around this level, there's some extra capital gain that I'm giving up. A covered call does put an absolute max on the amount of profit you can make if the stock rallies above the strike price that you've sold. You put an absolute cap on that. And so the thing about a covered call that you have to recognize is that you're doing that. And you got to decide that you're okay with it. In my case, that means that I've baked in about 50 cents of profit on a net result, on a net basis, excuse me. And no more. So what is the advantage of that? Well, this is the premium that I was able to generate. The truth is that there was no guarantee that the stock was going to continue to rally or not, or that if it did rally, that it wouldn't come all the way back and finish below the strike price that I've sold. We'll look at some of the other covered call trades that I have set, and you'll see exactly what I mean. But that means that this was 45 cents was in front of me at the time. So when I combine 45 cents, this is the premium, just call that pre, and here's 50 cents, which is the capital gain, assuming I get called out today. My net result on this is 95 cents. Again, still not quite the dollar plus, a little over $2 that I'd be getting if I had simply held on to the stock and I could sell it today at 25.36 or whatever the current price is, right? But again, I have no way of looking into the future at the time that I place the trade and say, oh, that's going to be $2 above. What I could see was an opportunity to bake in 50 cents of gain with an additional 45 cents of premium. That's what the known element was. And that was an active decision that was more than enough. So 95 cents against the $24 strike price that I was assigned means my net result here for a 1-month trade is almost 4%. This is really, really attractive, and this is why I was willing to do this. It's also why I'm actively recognizing that I'm giving up any other potential gain. This was the known element. And if I know that I can make almost 4% if I'm called out in a month, then that is more than enough to meet my goals and my preferences. It fits perfectly into my investing style. Anything else that happens beyond that is really becomes secondary. So I'm willing to accept that this is my maximum possible result because I can repeat this over and over and over again. What I can't repeat is is the potential gift that comes when a stock rallies significantly above the strike price that you've bought from a put sale. Um, there's no way of being able to forecast ahead and say that that is going to happen in the time that you've got. So I'm really just trying to work with known known quantities with what is right in front of me, and try to repeat that as many times as I can. And when you can repeat 4% every single month, again and again and again, well, you have a result that kind of speaks for itself. If 4% in a 30-day period of time doesn't sound attractive, you know, I don't know what else to say. And maybe the stock market isn't for you. Maybe you need to be looking at something else. Okay, that's Coterra. Again, if you're in any of these positions, you have a different idea. Please feel free to go ahead and post it. If you have a question about any of this, something doesn't make sense, please do go ahead and post it in the chat. Also, we've got 2 responses so far to the poll. If you haven't already and you go ahead and respond to that, that would be wonderful. Majority rules, we've got until the end of the session on that to see and figure out if we're going to be doing this session on Black Friday. Okay. Next trade up is Skyworks. This is a stock, again, I was assigned this around the same time as Coterra at $75. The stock was showing a lot of bullish momentum shortly after that, and I had an almost immediate opportunity to sell the 77.50 strike price and bring in, 4.53% for the next 30 days. $3.40 in premium on the stock was really, that's an abnormal trade. This is why I say if I can generate 4.5%, that's the known quantity in front of me, I'm going to go ahead and do it. Now, where Coterra is looking really nice in terms of calling me out of this trade. And by the way, I like getting called out of these stocks. That's a good result. That means that my maximum profit has been realized. It also means that my capital that I put in to buying the stock is coming back to me in the form of cash, and I'm going to be able to redeploy it again. That's what income generation is all about, is just being able to redeploy that capital again and again and again. So being called out of a covered call trade, that is a great result. Always is. Skyworks, here's where we are now. Now, to be clear, my assignment price is 75. And that is all the way up here, and the stock is now all the way down here at 61. So 77.50 strike price that I sold seems kind of irrelevant here right now. This is one of the things that we have to be willing to acknowledge as a possible result, not only when we're working with put selling trades, but also when you're holding stocks for long enough periods to sell covered calls on them. I clearly had an opportunity, if I had simply been holding the stock, to sell it and make close probably to $10 per share in profit, which I have not taken advantage of. Did I miss the boat? Did I do something wrong? I'm going to throw that out to you. I want to hear what your perspective is here about this. So some of you, I think I might know what your answer is, but I want to see it. I want to try to have a little bit of a dialogue here. Because let's face it, seeing the stock now down here at 61.50 when I was assigned at 75, that's not great. I don't love that. So was not selling here when the stock was pushing $80 plus. Was that a mistake? Was that a missed opportunity? Does this come back to Barry's original comment a little bit ago about what goes down usually goes up eventually if it's a good company? I still believe that. Thank you, Barry. Not necessarily a mistake, but possibly a missed opportunity for now, depending on your goal. And I appreciate that. I really do. If I'm being totally honest, yeah, that probably was a missed opportunity. I don't consider it a mistake though, and I do agree with Barry on that count. But again, my goal here is not necessarily to try to maximize my profits. This is an opportunity to kind of make a really fast, really impressive profit, and those can be gifts. And that's the missed opportunity part of this. At the same time, what I really want is what I'm really going for, remember, is to use put selling as a gateway to owning stocks I like at prices that I find to be attractive. Why am I willing to hold a stock for a possibly extended period of time? Excuse me. And with this 7750 call option clearly going to expire today, means that I'm going to be holding the stock for some time. It's going to take time for it to get back up to this price. And clearly, bearish momentum is accelerating. It might be finding support now in this $61 range, but I'm not totally confident about that. It may be lining up with some activity back here, but also, the yearly low is all the way down here at 48. That's way below my $75 strike price. So there could be a lot of downside left here. Well, it does come back to what my goal is. And my idea here is, do I still think that Skyworks is worth more than the price that I paid for it? The truth is, yes, I do. Now, we've got a new set of fundamental data to analyze from the last earnings report. I haven't gone through that in any depth yet, so I'm still waiting for some of that to filter through to my data feeds. But the other part of this too is this. I talked about dividends at the beginning of the session today, and just kind of in passing. But Tuesday, this is they declared a 71-cent dividend. That's each quarter. There's 71 cents in August. And so what that means is that this is all I have to do is own my shares here. So 71 cents times 4, that's $2.84 is the total income available on a yearly basis by doing nothing more than holding the stock. So if you divide that by my purchase price, which was 75, that's 3.78%. That's right up there with a lot of T-bills, treasury bonds. They might be a little bit higher right now, around 4%, but this puts me in that neighborhood. And from a passive income standpoint, that's more than attractive enough. And so by holding the stock, I've qualified for that dividend already. That'll be paid on the 9th of December. That'll be attractive. That'll help. It's not going to obviously totally mitigate the oomph associated with seeing the stock drop from 84 down to 60. That's a $24 drop. Let's not totally dismiss that. That is still a little bit of a gut punch. But as I mentioned, if I still believe the stock is worth more than 75, the fact that it's at 61, it's not, and I'm not saying it's irrelevant. I'm saying it becomes a little bit less important to me. As long as I still believe in the overall value proposition, I can hold the stock, bring in the passive income from the dividend, and wait these trends out. This is a stock that does experience pretty wide variations between highs and lows within its trends. This is a really good example. Here's a high at about 120 and a low at around 45 at the bottom of its downward trend from 24 to 2025. How about this one? Going from about 70 to about $200 on the upside from 2020 into 2021. Or this one, 80 to 120, 2022, 2023. So the moves over time for Skyworks can be pretty significant. That means that if I'm willing to be patient and I'm willing to keep the price action in perspective, then as long as these fundamentals hold, I can be confident that the stock is going to rally back, and it's going to get back above the price that I was assigned at. It may also, even if it continues to drop, and the value proposition is only getting better in that case, that may also set up some opportunities to possibly add to my position. Not sure about that yet. At selling one contract at 75 means I've got $7,500 tied up in my account right now, which is about 2.5%. That's right around the maximum that I kind of want to be at right now. So it's not a given that I would want to try to take on another 100 shares potentially. But depending on where the price is and what the overall fundamentals are, there may be an opportunity to do that, possibly just to generate some additional income. So I don't know. Right now, I'm going to hold course with the shares that I've got and be patient. Again, everybody, whatever your this is just my version of the story of Skyworks right now. Not everybody's going to agree with it. Each of us are going to have our own version, and that's totally fine. Again, if you want to compare, if you have a different attitude about this, if you simply maybe you simply decided to get out of the trade a while ago, then that's okay too. This does mean that in all likelihood, I'm not going to be placing another covered call trade on Skyworks for some time. So it's probably just going to sit in my portfolio for a bit until I see some recovery. Okay. So that's Skyworks. Next, we have Bristol Myers. And again, this is a stock. I've held this one since September. I was assigned at 46. And in this case, I was able to sell the $47 strike price and bake in about $1 of upside into the stock and bring in $1.01 on the premium. That's a little over 2.2%. And oops, the nice thing on this one was that this was for just a little over 2 weeks. So this is a really nice covered call trade. Let's take a look at this one. We'll see where it's at. Okay. So 47 is right about here. That's a little bit above the stock's current price. So it does look like I'm going to hold the stock a little bit longer. It is a little bit below the strike price that I was assigned at. Remember, I bought it right at 46, which is this price right here. And that's okay. That doesn't bother me. I've been able to use this for a couple of trades since I was assigned. Here was the first one, beginning of October, brought in $1.05 for the same $47 strike price. That expired. Looks like this one is as well. But after being assigned at 46 and being able to generate another $2 of premium, my actual net cost on BMY is actually around 44. So this isn't a bad result at all. I'm okay with this if I'm assuming it doesn't push above 46 before the market closes today. That'll just set up another opportunity for another covered call. It also means that I did qualify for this dividend that they declared on the 3rd of October. So it was assigned on the 26th. So all told, oops, let's go here. All told, here's the total income I brought in on this one. There's 75 cents from the original put sale. The $1.05 from my first covered call, and $1.01 from the current one, and 62 cents from the dividend. So that's $3.43. I've held the stock now for about 2 months, right? So let's divide that by 46, and almost 7.5% for 2 months of time. Okay, I'm okay with that. The stock has been picking up some bearish momentum. So from a practical standpoint, this could be, it looks like it might be stabilizing a little bit, maybe around 45. It might not. It could continue to drop and fall. And if it does, it may very well test this low back at around 43. But if it stabilizes at all here, then there's just going to be another opportunity for another covered call trade. So Barry brought in 91 cents for a $50 strike expiring today. So you did yours probably a little bit closer to here, where I did mine for 47, maybe probably a day or two earlier. But that's awesome. 91 cents, and you baked in possibly, hopefully, $4 or $5 of gain. That's a nice result. And again, if you end up holding it for a little bit longer, maybe that's okay. Come in at 47. Okay. So again, that's still a good result. Your net cost is going to be below 46, which means with the stock of 45.80, Barry, you're doing okay. Again, I'm not saying that it's going to stabilize here. It could drop. I'm not ignoring that. I'm saying that the premiums that have been generated so far have been enough to make this worthwhile, and to make continuing to hold the stock and to be patient worthwhile. This has been a very productive use of the $4,600 of capital that are tied up in owning this stock. This has been very productive. Okay. Next, we have SLB Limited. We've talked about this stock before in other sessions, obviously, but I was assigned this one. Held this a little bit longer, since August of this year, being assigned at 35. And I've had I've had a number of opportunities to generate income with covered calls here. This latest one just came up, as a matter of fact, 9 days ago. So this was a very near-term trade. I was able to sell the $37 strike price and bring in about 2.5% for that time. Barry, thank you. We'll get to your trade on Magna here shortly. So I sold the 37, but the stock is right around, the stock is right around the price that I bought the stock at right now. Again, here's what the momentum has been doing to it lately. So my 37 strike price call is up around here. So looks like I'm going to hold on to this for a little bit longer too. Again, I'm okay with that. That's not a bad result. I've brought in this dividend along with my covered calls, and looks like I'm going to also be bringing in this dividend as well. All of these help. It's the cumulative return achieved by the combination of dividends, premiums, capital gains, however that occurs, from the time that you take the assignment on the stock until the opportunity to close the trade out by being called out of a covered call trade. It's the cumulative result of all of those that we're going for, and that's what creates the net positive results that we're looking for. We don't always have as many opportunities. The stocks don't always give as many covered call opportunities as SLB has given me since I was assigned this stock. But this is a really, really good example of a stock that has been extremely productive in the time that I've had it. They're not all this productive, but a fair number of them do. Especially if you see a, sorry, I did not want an arrow. If you see a stock in a consolidation range like this is really, really good for generating income with. You'll be able to do a lot with stocks that are in these kinds of patterns. Okay, Barry's got a trade on Magna, so let's go ahead and hit that one. 47.50 strike expiring today as well. Okay. And it's a little bit below that, but showing some strength today. So you might still get called out of this. We're still early in the session, and he's in all the way here at 42.50. So you've got a nice result going on here, my friend. This is a good trade. The first tick was for the covered call on BMY. And this is the second one for Magna. So that's a really nice result. We're in a few calls along the way, even better. So this, again, been really productive. Upward trends are also very useful and create very productive income generating opportunities. So we like sideways. We like up. Down is okay. I'm not saying we love these. I'm not going to pretend that. But as long as the value proposition is still there, then that's okay, because you're on the hook for the dividend no matter what, exactly. So awesome. That's nice. Thank you, Barry. The last stock that I have that is set for expiry today is a covered call on Halliburton. Now, this is a stock that I've held for quite a bit longer than the others, and been able to use for a few covered calls, but not as many. Here I was assigned it at 26. This was back in March of this year. So I've been holding this for about 8 months. I was able to sell the $28 strike price, which, if I'm called out, gives me a couple of dollars of capital gain. Again, a 9-day trade to about 2.7% premium generated on this, which was really productive. And I always have to remember not to just take the first one on the list here. Looks like this is also, again, 27 is my strike price here. It looks like that's going to expire. Stock is down here at 25. Again, bearish momentum has been picking up on some on energy stocks lately. SLB is the example, CTRA as well, even though I'm being called out of that one. And so that's pushed these stocks like Halliburton and SLB down below the strike prices that I was assigned. But again, for Halliburton, after being assigned in March, 1, 2, and now 3 dividends, along with my occasional covered call trades, 17 cents, 17 cents, and 17 cents. So that's more than enough to be productive. This is a 17 cents times 3. Oops. 51 cents in total premiums in total income from dividends on this one. And let's go back to my assignment in March. Here we go. Brought in 56 cents on that one. Then I had a covered call here in April. Brought in 70 cents. So that was productive. And nothing else for Halliburton as it's we could see it kind of languished a little bit here. Here's roughly where it was at when I was assigned. And then we saw it drop and go through this trough before it rose. So it's not too surprising that I haven't had any other trades on it since then, until this most recent covered call, where I was able to generate another 70 cents. So my net income on this so far, on the hook sounds negative, but you get the gist. You bet. 247 when I divide that by my $26 assignment price, 9.5%. Again, not huge, but this is still productive. Remember, I'm only looking for good enough, and this has been good enough for now. And there is going to be a point where I'm going to have an opportunity to get called out of the stock, and that's fine. But for now, I will continue to be patient. All right. Well, we are a little bit past time, so I appreciate everybody sticking with me, and for your participation as always. I hope everybody has a wonderful Thanksgiving holiday. The vote is still split. So there were 2. You were called out of Halliburton on 1024. Okay, awesome. Thank you, Barry. 2 of you actually placed a vote, and Barry, I'm going to count you as a no. That means that we are going to go ahead and take next week off. So thank you. I appreciate everybody for your participation and for being here today. I hope again that you have a wonderful Thanksgiving holiday. If you have any questions between now and 2 Fridays from now, please don't hesitate to let me know. Reach out on Substack or Discord. Send me an email at rebelincomesystem@gmail.com. Thanks again. Have a great weekend. Talk to you later.